rates high, prices high. Why should I buy a home? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client. Or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed buying or selling decision, or help your client do the same. Explaining what's going on is not an easy task in today's environment. As a matter of fact, the CEO of Arnhurst, a prominent real estate investment firm, put it this way. I'd say whatever our forecast is, it has a wider range of error than it normally would have. We're just at a point in the housing market to where I don't think anyone really knows, to tell you the truth. But we can't ignore that inventory remains down over 40% since pre-pandemic. So what is he saying? Two things. Number one, no one really knows for sure what's going to happen next, and we can make some good guesses, but we have to recognize they're just guesses. Number two is the only thing we know for sure is that there's not enough inventory out there. If there's not enough inventory out there, that guarantees two things. Firstly, prices won't crash because this is a supply and demand issue. And secondly, we have to find more listings. Both of those things are true. So surely if supply is so low, then this would be reflected in home prices. Well, Black Knight said this. For the second month in a row, home price growth trended higher in every one of the 50 largest US markets, mirroring the sharp re-acceleration at the national level. They're actually seeing prices picking up right now. And to that point, the chief economist at CoreLogic had this to say. Nevertheless, home prices are still expected to re-accelerate and reach a mid-single-digit growth rate by the end of the year, according to CoreLogic's latest home price index forecast. So what are we looking for as far as prices are concerned? They're strong or stable at the very least. Let's hope that they don't re-accelerate, because with the affordability issue being what it is today, we really can't take on rapid price growth right now. We need steady price growth. Affordability, as we know right now, is in a crisis mode. There are a whole bunch of young people, a whole bunch of older people. There are a whole bunch of families that have the American dream of home ownership, but they can't attain it right now. If we look at monthly mortgage payments from the National Association of Realtors, look how much they've increased since January 2021, or even how much they've increased since January 22, or even how much they've increased since the beginning of this year. There's a major challenge there. Interest rates are nowhere near where they were the last several years. From 2016 all the way to 2022, mortgage rates stayed under 5%. Then in 2022, they shot up, and now they're going even higher than that. So what we have is a situation in which mortgage rates are really impacting affordability in a very big way. But don't misunderstand affordability challenges with people losing interest in buying a home. This chart is from the Housing Trends Report by the National Association of Home Builders. You can see intent was going down in 2018 and into 19, and then obviously in the first quarter of 2020 we had the pandemic, and all of a sudden things shot up because the meaning of home changed for many Americans, and that intent has been bouncing around ever since. Presently at 17% of people surveyed showing the intention to buy a home in the next 12 months. But if you look from 2020 to now, intent has only increased. People are still interested in buying a home. During the time of the pandemic, I spoke a lot about the concept of pent-up demand, meaning as we were experiencing the lockdown, people wanted to buy a new home, but they couldn't because, well, we were on lockdown. So the demand built up and built up such that when we came out of lockdown, home price appreciation was unprecedented. Well, what this chart confirms for me is, once again, we are seeing pent-up demand, but what's holding us hostage this time around is not a government-mandated lockdown, but instead it's an interest rate imposed lockdown that is psychologically discouraging for buyers wishing to make an interest into the market and sellers wishing to make a move, not to mention the affordability issue. But this interest rate environment will pass and a better one will follow. And when that happens, I think I've said this 3 months in a row now, when rates drop, the pent-up demand will seek release, and those who waited for lower rates will lose all the benefit of having waited by paying a higher price. Let's talk about net worth. The Fed does a study every 3 years. It's called the Study of Consumer Finances. One of the things that comes out of that study is the difference in net worth, the gap in net worth between homeowners and renters. And what we could see is going all the way back to 2010, right in the aftermath of the housing crash, when prices had already plummeted. Still then, homeowners had a greater net worth than renters did. And as we go forward in time up to the last study that was just released about a month ago, which covered through 2022, you can see the spread is growing dramatically. Now, I'm not suggesting that the last hiccup from 2019 to 2022 is going to continue. That had something to do with the Russian price appreciation during the pandemic. That will moderate. But what's going to happen to that green line? It's going to remain relatively flat. So the spread isn't going to really change much. It's going to increase slowly like it did between 2010 and 2013, but it's still going to increase. So here is the point. Despite what the interest rate environment is, despite the fact that homes are way pricier now than a short 24 months ago, for the vast majority of families in this country, home ownership is the number one builder of their net worth. Whenever it's applicable, I like to tell the story of the first home I purchased. The year was 2006. I was 24 years old and I had no idea what I was doing. I used 100% financing to acquire a $250,000 property at the top of the market. Like a brand new car, on the day I signed for that house, it was worth less than what I paid for it. And that was just the beginning, because by 2010, it was worth less than half of what I paid. I was desperately underwater, not only because I had put zero down, but also because the loans I used were both interest-only loans. So I still owed the $250,000 I paid when the home was only worth $110,000. But I decided to stay the course. Instead of waving the white flag and giving the keys back to the bank, I moved out, I put a tenant in the property, I was able to refinance into a fully amortizing loan despite being underwater. And for years, I enjoyed all the depreciation tax benefits that come with owning investment real estate while my tenant paid down not all, but a large chunk of my monthly expense. Fast forward to 2021, I was able to sell that property for $300,000, netting not only the $50,000 of appreciation, but also all the loan amortization that my tenants paid down all those years. That house today, by the way, will trade for $420,000. So the moral of the story is this. During our lifetime, knock on wood, things are likely to never be worse than the 2008 crash as far as real estate is concerned. So if my timing and decision making could have been that bad, and I still lived through the 2008 crash and came out on top, then why can't anyone else in the current environment? If you just have a long enough time horizon, the likelihood is that with real estate, you will win. Right now, the interest rate environment is just noise. Why? Because I know rates will drop. I can buy now and refinance later. The fact that homes have appreciated as much as they have over such a short period of time is just noise. Why? Because I still see a supply constraint. So when these factors are in play and you have a long enough time horizon, whether you intend to live in the home or rent it out, real estate as an investment is tough to beat. That's a wrap for the December market report. I appreciate you listening in. Forward, subscribe, share. Happy holidays to you. I'll be back next month, but before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.